Got Casey Boland joining me with Hanghold Capital Management. And Casey, any investments I've had were always earmarked for retirement, so I'm not one of those who frets with every quarterly statement. But there are a lot of people out there, and a tendency on the part of a lot of people to look at long-term investments in a short-term way.
Yeah, I think it's very common to look at this. Information's a double-edged sword. The investment industry years ago, it was more you were in the dark. This was the pre-internet age of insider tips, expensive research subscriptions. You get phone calls. There was a lack of historical data to really look at. Today, but people have access to all these opinions, analysis, real-time prices, but oftentimes this really confuses people, and they look at things from a short-term basis because of all the information we have coming, and I think they confuse it with their long-term capital and what it's really set to be used for.
So it's fine to be informed, just don't be overly anxious.
No, and you see this even with the professionals. There was a great story by CEO Larry Fink of BlackRock, and he was having dinner with a manager of one of the world's largest sovereign wealth funds, and the fund's objective, the manager said, was generational. So he was asked the question, how do you measure performance? And he answered quarterly. And so you're answering quarterly, but your objective is generational. Those things just don't align.
Yeah, if you do that, your problem is you end up chasing past performance as opposed to looking to the future.
That's right, and that's what we constantly see. People ignore any semblance of a long-term plan. You end up being reactive instead of proactive, and because of all the trading, you're going to incur more fees. You lose sight of your actual goals. So you lose sight, and you have to keep things in perspective.
So the strategy that you follow, you call the bucket approach, which is?
Yeah. It's a good mindset way to think about it. When you think about your portfolio in terms of various time horizons and risks, that means then you keep enough liquidity and cash in high-quality bonds, and that's going to be one bucket for short-term needs. Then you structure the remainder of the portfolio to meet various intermediate and long-term goals. That way you've created a portfolio based on your personal needs, objectives, without allowing what others are doing to impact your decisions.
Good enough. All right, Casey, thank you very much. Have a marvelous weekend. Ahead we'll have traffic, weather, and hey.